All right, let's talk about something that every long-term investor needs to master, the portfolio tune-up. We're going to demystify portfolio rebalancing, breaking down what it is, why it's so important, and how it really works to keep your financial goals right on track. So let me just ask you this straight up. Is your portfolio out of balance? And I'm serious because you could have set up the absolute perfect mix of investments a year ago, but the market has a funny way of quietly knocking things out of whack, leaving you with way more risk than you ever signed up for. And there's actually a name for this. It's called portfolio drift. Think of it like setting the cruise control on your car. You think you're going straight, but over time, you start drifting into the next lane. Maybe your stocks have had an amazing run and have grown way faster than your bonds. Well, before you know it, that safe 50-50 portfolio you built is now a super aggressive 70-30 portfolio, and you didn't even make a single trade. And that brings us to the real heart of rebalancing. And this might actually surprise you. Its primary job isn't to squeeze out every last drop of profit. It's something else entirely. This quote from Vanguard just nails it. Rebalancing is all about playing defense. It's a risk management tool first and foremost. You're not trying to chase returns. You're trying to pull your portfolio's risk level back in line with what you were comfortable with from the very beginning. And you know what? Let's be real. This feels completely backwards sometimes. It means you have to sell your winners, the very things that have been on a hot streak. And then you take that money and buy more of what's been lagging behind. It takes serious discipline to fight that emotional urge to just let your winners ride. But check this out. This chart from Vanguard shows you exactly why that discipline is so critical. Look at a simple 50-50 portfolio. The one that was rebalanced every year, it stayed right around 51% in stocks, pretty stable. But the one that was just left alone, it drifted to an average of 81% stocks, and at its absolute peak, it was 97% stocks. That's basically an all-stock portfolio, and you can see the volatility just shot up as a result. That's a ton of unintended risk. Okay, so let's make this more concrete. We're going to look at a real-world case study comparing two totally different ways to invest in the exact same companies, the tech giants in the NASDAQ 100. It really boils down to this. Are you trying to build a growth engine or an income generator? So in one corner, you've got QQQ, what we'll call the growth engine. It's simple, it's passive, its whole job is to just track the NASDAQ 100's performance. In the other corner, we have JEPQ, the income generator. This one's actively managed, and it uses a more complex strategy with options to create a big, steady stream of income. That difference in complexity is pretty much why JPQ has a slightly higher management fee. And when I say a big stream of income, I mean it. Look at that. JEPQ's dividend yield has been sitting over 10%. For anyone who needs cash flow from their investments, a number like that is pretty much impossible to ignore. Now, let's compare that to QQQ. Its yield, less than 0.5%. So you see, these two are built for completely different purposes. One's for growth, the other is all about that income. But income is only one side of the coin. The other is risk. And this chart tells a heck of a story. During the worst of times, QQQ saw a max drawdown of almost 83%. I mean, that's a devastating loss. But JPQ, with its income strategy, had a max drawdown of about 20%. Now that's still a hit, for sure, but that's a world of difference in terms of downside protection. So you're probably wondering, how on earth does JEPQ do that? How does it generate all that income and provide that kind of cushion? Well, it all comes down to a strategy known as a covered call. Let's break this down real simple. First, the fund buys and holds the stocks, just like QQQ does. But then it sells something called a call option against those stocks. This is basically a contract that gives another investor the right to buy those stocks from the fund at a higher preset price in the future. And for selling that right, the fund gets paid cash up front. That cash is called a premium, and that's the income that gets passed along to you, the investor. But as they say, there's no free lunch in investing. Here's the trade-off. By agreeing to sell your stocks at that preset price, you're essentially putting a ceiling on your potential profits. If the market just goes on an absolute tear and skyrockets past that price, you miss out on some of those massive gains. You're basically trading some of that lottery ticket upside for more income right now and a much softer landing when things go south. Okay, let's switch gears and get practical. Because as soon as you start actively rebalancing or using funds like these, you're going to bump into some real-world rules and, of course, everyone's favorite topic, taxes. And this is a perfect question from a real investor over on Reddit. This person is dealing with a classic headache that anyone managing their own portfolio faces, the wash sale rule. So the wash sale rule is the IRS's way of stopping people from gaming the system. You can't just sell something at a loss to get a tax break and then immediately buy it right back. So if you're rebalancing and you sell an ETF for a loss, you can't claim that loss on your taxes if you buy back that same ETF or one that's substantially identical within a 30-day window. It's a really important rule to keep in your back pocket. Now, on the other side of the tax coin, these income-focused ETFs can have a really interesting tax benefit. And it all has to do with how those big monthly payouts are labeled by the IRS. A big chunk of the money you get from funds like JEPQ might be classified as a return of capital, or ROC. The best way to think about this is that the IRS doesn't see it as income you earned this year. Instead, they see it as the fund just giving you a piece of your original investment back. This lowers your costs for the shares, and the beautiful part is you don't pay taxes on that money until you finally decide to sell. It's a really powerful tool for deferring your tax bill. You know, at the end of the day, all these products, all these strategies, they all boil down to one simple question. What is your goal? The best choice has very little to do with the numbers on the screen and everything to do with what you're trying to accomplish with your life. I mean, look at this comment. It couldn't be more direct. We are old and we need income. For someone heading into retirement, the game changes. It's not about growing the biggest pile of money anymore. It's about turning that pile of money into a reliable paycheck to live on. But then you get a totally different motivation right here. This person isn't talking about a traditional retirement. This is about financial independence. It's about building an income stream so powerful that you get to be the one who decides when it's your last day at the office. And this quote, man, this just wraps it all up perfectly. It's the whole philosophy in a nutshell. This is someone making a conscious choice. They are willing to accept that trade-off we talked about. They're willing to give up some potential future growth for the freedom to live the life they want right now, not 40 years from now. And that's really the final question, isn't it? The one only you can answer for yourself. When you look at your life, your goals, your timeline, what does your portfolio need from you right now? Is it time to fuel up the growth engine and let it run for the long haul? Or do you need to plug in that income generator to start powering your life today?